Twitter is the new Paanwala because I think influencers have really changed the game. Core idea is this: don't stop learning. You don't even invest in the market, invest in yourself. Get a new course, do a little travel, meet people. If you're borrowing and investing, stop. Angels can fly because they hold themselves lightly. If you don't bet, you can't win. But if you lose all your chips, you can't bet.
On today's episode of Money Moves, we have the master of markets, the Yoda of FinTwit, the commander of compounding, Deepak Shenoy. Deepak was born into a family of bankers. He started a company of his own, went bankrupt, built himself back up, and now runs Capitalmind, which has about 2,000 crores of assets under management. It's a portfolio management services company. They've applied for a mutual fund license as well. Deepak is also the author of Money-Wise, Timeless Lessons in Building Wealth. Ladies and gentlemen, Deepak Shenoy. Deepak, welcome to the show.
Thanks, Jayadevan. How amazing that we met. I think we met about 10 years back, nearly 10 years back, and then now we're meeting again in different setting where both of us are in probably different effective professions in that sense.
Absolutely. I also want to talk about a secret tool that I discovered on Capitalmind on your website, but we'll get to that towards the end. This is my attempt at hook. So Deepak, let's start this. I want to get straight to the point, which is your favorite Paanwala story from back in 2000, February.
Oh yeah. This was I think 2000 February or March. And before what effectively became the .com bust. So there was a big euphoric time, and that euphoric time was largely led by .com companies in the US, but also brought in a lot of capital into India, and a lot of companies were set up. The IT companies in India went berserk at the time, and as much as we talk about retails participating in equity today, it was much higher than as a percentage. Mutual funds were relatively small. Everything else was just the foreign investors versus the retail investor in India, and everybody was buying. So at this time, a Paanwala near my office actually told me to buy HCL Tech, and not HCL Tech, digital equipment. Yeah, that was what it was. And then he told me to buy it, and then we already owned a bunch of shares. I remember trading at about 1,300 or 1,400 rupees per share. I had no idea how to do anything with shares, so it just looked like a number to me. Then the stock fell nearly 60-70%, and it was a tough time. You wouldn't assume that people would take the advice of a Paanwala or something like that, but it wasn't advice. It was really like he said something, and I said, okay, if you already own the share, it must be good, because my father had bought it. So let's buy 10% more. But it should have been a signal, because this is a guy who would never talk to me about stocks in his entire life. That's a warning sign. And then you say, well, if that's what you're telling me, then you're probably thinking this is a bubble of enormous proportions. But I think there will be a time in your life when stocks are discussed as if people are so confident about the stock's future when they never talked about these things ever in their life before. And suddenly you find that that might be the time when you kind of find the bubble kind of building up. But I mean, that was a story that was interesting because it was real. It happened to me, so I resonate with it. It happened to me later also in 2007 when the person who used to iron clothes for us watched me on watching CNBC, and he said he also trades, and he was giving me some stocks to buy. And at that time, I was just in the process of starting a company that was doing algorithmic trading in stocks. And then I realized that this was an extreme. But I also realized that maybe last time it was lucky in the sense that I could pinpoint roughly the top because it was February 2000. But this was probably September or October of 2007. The market still gave another 30% after that.
You've talked about Uncle Point, in some of your conversations. Are we there yet, and what exactly is the Uncle Point?
So that is basically, the point where if you're a trader, you're usually leveraged, like you're taking margin calls and all that stuff. At some point, you lose so much money that you got to call your uncle for help, right? So that's the point at which you kind of, and people take those calls a little bit earlier than going actually bankrupt, because at bankruptcy you have nothing. So there's this quote that says, if you don't bet, you can't win. But if you lose all your chips, you can't bet. So you shouldn't lose all your chips. So somewhere before that is the uncle point, right? At the point at which you know you're going to lose everything if you continue. And this uncle point is typically a call that says, well, I don't think whatever I'm doing is going to do well anymore. So I need to change things, and I need to stop whatever I'm doing and go back to the drawing table and listen. That's the uncle point. For most people, it's a sign of frustration of leaving the markets and not coming back. For more experienced traders, it's more like, listen, I know what is happening now. Whatever is happening is, I am too involved in it. I need to go back up to the 50,000 square feet level and then come back. So a person earning a few lakhs a month is adding maybe 10,000 rupees or 12,000 rupees per month. And even after a couple of years, this is not meaningful amounts of money, because his earning itself is more than his corpus. He's earning per month, or maybe he's earning in 2 months what his entire corpus is worth.
Like you said, like, if you're in it for the long term, you look at it as, hey, I own ABC ka itne shares, and not so much as like, in percentages, how much am I up or down kind of thing. Unless you're in F&O, which is absolutely right. Do you see this, sort of recovering in the long run? Like, where does it go from here?
So in general, the worst words to say in the market is that this time is different. And therefore, to say that the corollary of your question, which is that the markets will never go up, is that this time is different, because the markets have always gone up, right? Through any downturn. In fact, it was at an all-time high like 6 months back. So given that, I would say anytime somebody tells me this time is different, and quotes examples of, say, China or Japan or something like that, I keep saying that, listen, it's possible. There's a remote possibility, but it's not. We're not different this time. It's the same overvaluation.
Got it. You've been sort of looking at the, developments, which is mostly current affairs, like, what's happening with Trump. I think that's had an impact with the tariff wars, like, US market wakes up and goes like for a, toss in the morning, and then, I think Indian markets also react at some level, like, and then you have this whole protectionist kind of a view coming up, in most economies, like foreign investors selling. That's another topic that I've picked up, like, from India, and, taking the money out kind of thing. And finally, retail investors panic selling, right? Like, did we get all the reasons right, or like, are there other things that we can now in hindsight look back and say, okay, this is why the market is probably behaving this way?
Well, you will always find reasons. They always come after the fact. Right? Some random thing will come and say that's the reason. But I mean, in general, markets are like this. They will overvalue, they will undervalue. Retail investors are buying, foreign investors are selling. At some point, foreign investors will stop selling, and retail investors will probably continue to buy, and the markets will go up at that time.
I want to come to a segment where our listeners can have takeaways from. We've discussed the macro and all of that. How should we respond as investors?
Yeah, I think, see, the early stages of your life, and I've always said this, in the book as well, focus on earning more money, not necessarily making more returns and all that stuff. Your investments, whether they're equity or debt fund or an FD, doesn't matter. Relatively speaking, you're small from your own self. Most people save like maybe 10% of their income. So even after a year, they have 1 year, at best, 1 year of salary sitting in the bank. And this would be a great thing if people actually did that. Not 1 year, one month of salary, a little bit less than a month of salary. Then the salary goes up. Then the amount that they've saved so far sounds inconsequential. So whether that gives you a 10% return or a 15% return is meaningless. So if you earn a lakh a month and you save 10,000, after a year you have 1.2 lakhs. Maybe that's gone up to 1.5. Now this thing goes up 10%, it gives you 15,000 rupees. If it goes up 30%, it gives you 45,000 rupees. You're earning a lakh, your probably salary has gone up to about 1.2 lakhs, 1.3 lakhs a month. That's still, if it went up 30% in a full year, you would make half a month's salary. Think about it like that. It's not meaningful to your life, right? So essentially, you got to build your corpus to a point where it is 3 times your annual salary before you start worrying about returns, because then the numbers start seeming significant, right? If you're borrowing and investing, stop. If you're somebody told you that I took a home loan and instead of paying back the home loan, I'm putting my money into the market, stop. keep paying back your home loan whenever you can, and therefore reduce that amount outstanding. And over time, you'll find yourself at a point where you can invest in the markets in a different at a different scale. In general, if you like small caps, and small caps have done amazingly well on a 20-year period, right? Then you should stick with that strategy, because small caps as a theory will always do well in the long run. They may not do much better than the indexes, but they give you a different style of performance, and then you might have a small portion of that in your portfolio. Why are you trying to change that right now? Let it be that small portion. It should you should be continuing to invest in it as you invest in the other portions of your portfolio, and then keep on with it. If you're a professional in the markets, you can try to time it, do things like that, but typically these people are the people who think they're professionals are very high in a bull market, and the people who are professionals are only the ones left in a bear market. So in that sense, you have a dichotomy over there. But what I would generally say is, don't bother trying to time it. Just keep your investing going over a long period of time, and I think in the long run you will make reasonable amounts of money. You don't even invest in the market, invest in yourself. Get a new course, do a little travel, meet people. You will get more return on that than you will on the markets. It's a hobby for many people. That's the problem.
So in your book, you also talk about picking an an advisor, right? And then you talked about one category of advisors who kind of every now and then they come to you and they churn your funds, and then you end up with a long list of funds which are we don't know what we're doing with it, right? But then you also have a nice practical take on it, which is saying keep it simple, A, B, C, D. If you can just quickly run us past that piece.
So there's nothing wrong with index funds, because they will not give you more than the index. They will always give you less than the index, but they're simple. They just work, for that matter. If your idea is to choose index fund, just choose the largest, and you don't even need an advisor for that. But you may need an advisor for your life. How much do you need in equity? How much do you need in debt? Many people don't know that they're doing really well for themselves. Many people don't know that they're doing really badly. They'll come to you after the age of 40 and say, I have 10 lakhs in savings. And I'll be like, okay, this is not enough. So you go to, because their lifestyle involves spending of, say, 1.5 lakhs a month, and you're looking at that and saying, look, 10 lakhs is not going to get you anywhere. If you need to save more. They say, okay, we're willing to save. So this is advice, right? So you're actually going to have to give these people a structured plan. That is where the advice comes in. There's a XKCD cartoon about this. A guy standing on a stage with a lottery ticket in his hand and saying, listen, I bought one every day, and I won. This is what you all should do. But it's a survivorship bias, right? Most people can buy lottery tickets all their life and never make any money. So the problem about I succeeded, you should follow me, is that it could be survivorship bias and just luck. And on the other hand, it could just be the fact that you only need to get rich once in the markets.
Survivorship bias.
Survivorship bias has, so one of the problem with that is that you listen to this kind of advice too much, right? So then that's where the problem is. I think if you stop listening to Twitter is the new Paan wala.
Yes.
You stop listening to this gyan that is peddled from outside. It's like they'll tell you about diets. Don't eat this. Eat low carb, high fat. Eat no fat. Everything works.
I want to move into another segment, which is you rate a few contrarian takes or takes. The first take, very popular recently. Shankar Sharma, who's like a investor, he talked about how the Nifty 50 will not return more than 0% for the next 4-5 years. How do you rate this take, and what is your take on this?
So Shankar is a great guy, and he's been around for the longest time, but he's almost quintessentially bearish in a market that has almost always been bullish. So it's difficult to get that. So it's not like he isn't bullish, but sometimes his bullishness comes as his preference for stocks that are relatively not so great in terms of governance and all that stuff. So those get highlighted as well. Say, oh, you are bullish about this stock and it's gone down, and you're bearish about the market and it's gone up. But it's an opinion. And I think he brings in interesting insights when he does, right? He'll throw in the data. It's useful to look at it, but you have to have water off a duck's back. When the markets are going to come back, you're not going to look at it and say, but Shankar Sharma said it. So he's Shankar Sharma, he's saying it. Tomorrow he can also change his mind.
Absolutely.
Right? Something will happen and it will change it. It's fine, and it's all opinions are there. So it's a great opinion to have. And a friend told me, and it's an amazing saying. Um, uh, Angels can fly because they hold themselves lightly. So you should take others' opinions lightly and say, "Ha, they have an opinion,"
Yeah.
which is already. Somebody comes and tells you you're a bad person.
Yeah.
Does that make you feel lousy? Like, you think I'm a bad person?
Yeah.
All more power to you.
Yeah.
But I don't care. Beyond the point, right?
Yeah.
What you think, it don't matter to me.
Yeah.
Look at kids. I mean,
Yeah.
kids are not going to listen to you if you tell them you're a bad person and all that. They will, you're a bad person. I'm for telling you you're a bad person.
Makes sense. Samir Arora, investor, he recently talked about FIIs, shouldn't be looking at India. Not so much as shouldn't, but it doesn't make sense for them to look at India because we are the only country out of 200 countries which has capital gains tax for foreign institutional investments. How do you rate this take, and what is your take?
It's nuanced. He isn't exactly right in the sense it's not all capital gains. Almost all countries have different capital gain structures, but what they do is they tell foreign investors, you come into our stock markets, no, we don't tax you. Because we don't tax our own institutions. Like mutual funds in India are not taxed. But if you come and buy real estate or private companies, we'll tax you.
Yeah, of course.
That many countries do that. In Saudi Arabia, Mexico, all of these countries say, oh, we'll tax you except if you buy stocks in our stock market. Mexico says, listen, if you are being taxed in your country, then I won't tax you. So, or you come from these jurisdictions, if I have a double tax avoidance agreement, I will not tax you on stock market investments. So, he's right in the sense that India is the only country that taxes foreign investors on Indian stock and bond market investments. In both cases, we are a negative compared to the others, though I don't think it's the reason for this bear market.
Yeah, so Neil Borate, he talks about how finfluencers are a problem in today's environment, and I'm paraphrasing, but he puts out great content, so which we all follow. So, what is your take in the sense that sometimes you also feel influencers actually take the content to the masses, like they actually help in growing the pie. And because we've had all of this for many years, right? So, but we still have about 5% of India investing, right? So, what's that balance that we need to strike here with respect to influence?
Yeah, I think you'll always get a little extreme, and sometimes people are frauds because they know their stuff doesn't work and they're still doing it. But you'll get all types, and you'll get all types in no matter what market. Are you telling me that the car sales market, people should not be allowed to sell their own car second hand because some people sell bad cars to people who don't know how to analyze how a good and a bad car is. So you buy the car, you drive it for a few kilometers and you're like, boom, it's gone. So then you're like going back and saying, but he says you already bought it. So do you then regulate people from selling cars at all second hand? I think that's a bad idea. So bad conclusions would be to ban influencers. The good conclusions are find the frauds and find out if there's a point at which information was not disclosed, because in the end the buyers need to be aware, and if the buyers are aware of the risks, then they can't complain, come back to you and say, well, I didn't know the risks. As long as I knew the risks, you're fine, right? So you can do whatever it is that you want, as long as you don't have an intent to fraud and you don't have you have done the right disclosures. I think you should be fine. And the education bits are well taken, because I think influencers have really changed the game in terms of bringing the education to the markets. So we should have a much reduced regulatory overbearing regulation on people talking about economic stocks, markets, and all that stuff. But we should have a higher bar to disclosure. We should require people to have higher disclosures when it comes to their interests, their biases, their earning capacities. And I would say this for anybody, including Neil and me, that we all earn from the same source, which is the people learning about markets and all that stuff. So in the end, we are all biased in one direction or the other. So we are influencers, whether we like it or not. And I don't think there should be a blanket term saying influencers are bad. It's like saying humans are bad.
You've said in the past that there is security in running and owning a business instead of being an employee, and more people would say jobs are secure, right? Today it feels a lot more prescient, because you're going to see a lot of job displacements with AI, especially we're sitting in Bangalore, there'll be changes in the way jobs are done, or, you're rewarded for doing certain tasks. how should I, look at, investing or just staying afloat, or, career, life, etc. It's a slightly broader, zoomed out view as it intersects with AI, right? Like, the changes that are coming.
So I think learn AI. So use AI because it's going to be a part of our lives. Second is if you have the propensity to run a business and take a business stance over here, of course do so. I think it's a better way to earn a long-term income than trying to be an employee for the rest of your life. But I think India has also proved, Bangalore for instance, proved that being an employee also can make you reasonably rich.
Yeah.
A lot of people, in fact, a lot of VC-run companies are essentially VCs owning most of the companies and everybody else being an employee, including the founders. Not saying anything about this, but there is no negative or downside to it.
Yeah.
It's just that owning a piece of the business gives you a larger payoff at the end of that. But I think your jobs are forever going to be disrupted. Whether you like it as AI, you call it something else, you're getting disrupted all the time. The best thing is disrupt yourself.
Yeah.
Say that what I am. I moved out of a tech job into finance because I thought tech will become disrupted in the way that I was seeing it. And I was saying I wanted to be part of something that was that had a much larger runway. Not that tech did not, but I think I found a better way to kind of capitalize on it than the IT services world.
Yeah.
But the idea over here is you have to find what works for you. So I would generally say to keep it short.
Yep.
The core idea is this: don't stop learning. If you don't stop learning, you will find a job or run a business.
Yeah. Another question on risks, and you've said that it's okay to ride the tiger once in a while, and nowadays, like with FNO and crypto and all of that, there's many opportunities to leverage, do all of those things. In your point of view, how would you sort of say I should ride the tiger or I shouldn't? Like, is there any time frame?
Oh, yeah. For instance, I never rode the crypto tiger myself.
Yeah.
That was because I inherently thought there was a regulatory risk in it.
Yes.
So I have a regulated industry, so I don't want to go down that route. But I think crypto has taught us a lot of good things. So we should adopt some of that, whether it's a blockchain, 24-hour markets, a lot of interesting ways to kind of price things automatically as well. However, I feel that there are times when you know stuff in terms of like stock markets. I know that there are times when they get extreme and there are times they come back. In the times when they're getting extreme, I feel that it's a great time to ride the tiger because the upside that you can get by one big move can negate downside offsets of at least 3 times. So you can actually, because every one big upside comes with one downside and so on.
Yeah.
I think if you ride enough upsides and control enough downsides, you will make phenomenally higher returns. And I would apply to this anything, whether it is crypto or not. I just didn't participate in the crypto thing because of the regulatory risk. But it's the same thing whether it is gold. So gold's going up, buy it. Gold's reaching a point and it starts coming down, sell it. Because it's gone up 50%, it's fallen down 20%. You still made the interim 30, right? You should do this, I think, in general across your life. And this is how you deal with it in life. When a cricket player is in form, you say that I will bet on that person to make the century. You're not thinking that, oh, this guy hasn't scored a century for like 6 years and is number 10. So let me hope that he will make that century.
Yeah. Got it. Last part, which is, some of the big trends that you're seeing, like, we're seeing weaker rupee and, we're seeing softness in consumption as an India story, sectors that you feel like are exciting in the, next few months, sectors you're not very bullish on, like, any broad thoughts on some of these points?
Oh yeah, I think Indian manufacturing is a great sector to be in. I think people in India don't manufacture stuff. I was talking to somebody else who was trying to make a 3D printer and he was saying that in India we don't even care so much about accuracy because he's trying to make an aluminium tube or something like that just to make sure that the frame of a 3D printer is right. He's got the dimensions right. He sends it to this company that does cutting for aluminium and it sends you stuff which is off by like 0.3 or 3 or 4 mm. He says my tolerance is 0.1 mm. And so we need those precision, but we don't care about it yet. So we want to be manufacturing, we want to do things which are much more deeper in in terms of depth of things we do, and people are willing to pay. Because the same person who's doing this aluminium frame from Indian guy, he's willing to pay 3x or 4x for something to come from China because he knows it's going to be the exact standard. So it's not like we're not willing to pay. We were always willing to pay for great textiles. We used to export most of it. But I think Indian manufacturing will come back because now people will start looking at the demand almost by force, because every other country is going to tariff you to existence. So therefore, I think you're going to have this problem. Things you should avoid right now are the weaker NBFCs perhaps, because India has gone through a consumption cycle, and therefore some of that weakness is going to reflect in banks' balance sheets. Weaker NBFC balance sheets for sure, banks maybe not so much. We should also have in general a trend of weakening and strengthening rupee. So we haven't allowed the rupee to strengthen at all, even though we've had big inflows. So I think not having those big inflows has created a lot of problems in the rupee right now. But at some point those inflows will come back and the rupee will strengthen as well if we allow it to. I hope this time we've learned our lesson and we'll allow it to strengthen as well, because it will always weaken when people leave. And the second one is that you have a trend of FIIs leaving and all that stuff. They're becoming less and less relevant to the Indian markets. Tomorrow they'll be even less relevant. We should be assuming that it's going to be domestic investors that hold most of our markets, which is the case in most developed countries. Domestic investors hold most of their stocks. So we should assume that a lot more investments will happen from India, and perhaps the foreign investors will not matter as so much. So from a news or a directional point of view, the idea is that India is getting a lot better in terms of, although domestic consumption will come in and go, but in the end you're not seeing any less consumption meaningfully of the same product. It's just that there's more competition for it. So earlier there was only a Blinkit. Now there's a Blinkit, a Swiggy, a Zepto, a Flipkart Minutes, something else. The same demand is spread over 5 people. Everybody sees lower volumes. Does that mean that the volumes have actually come down? So the consumption story being off is because the big guys are saying, I'm not selling enough Maggi. Okay, there's not enough people who care about Maggi because I have 5 other people who are selling me good noodles. So maybe that's what the problem is, and it's not that you are seeing less consumption.
Okay, thank you. I wanted to quickly touch upon the secret,
Yes.
tools that I found on Capitalmind. It's not so much a secret. The reason I called it a secret is because I don't think many people know about it, and I think everybody should know about it. It's the calculator that you have on your website.
The plan, yes.
Yeah, it's not trying to upsell me anything. It's a very clean interface. And we get a fairly good sort of view of how we should be investing, and also speaking from a little bit of personal experience. So I went to a financial advisor. They sent me a PDF. I said, can you give me an Excel sheet? And they said, no, we can't, because I wanted to do the calculation myself, right? But I guess this which is why I said it's a nice tool. All of you should check it out. A link in the description. And finally, Deepak, thank you for being generous with your time. Any parting thoughts for our listeners?
Oh, I think it's an interesting time to be in markets in general, but I think this is also part of life. This is your ups and downs, rather this is a downs part of life in terms of the market, right? But your ups may will come from your career, your life and living and all that stuff. I think markets are meaningful things for people who run it as a business, and for you also to run it as a life choice. I mean, to have a small amount of investments in there, but don't make it your life. In the end, money's only use is to be spent. So whether it is today or tomorrow, and you're saving for tomorrow's spending, right? So the point is, when you get it, spend it, and I think that will help your own your own investments, because in the end you'll benefit your own companies that you buy, but more importantly you'll live a happier life. I think we have this thing saying live better and things like that, and in fact I think that's what the goal of an asset management company should always be, is to help their customers live better, not to tell them that I'm going to give you the highest returns possible, this, that and all that. All that are secondary. If you help your customers and investors live better, that's a great thing to see. Retire at 45 if you must,
Yeah.
But don't retire because everybody else is telling you to retire.
Yeah.
Retire because you want to.
Yeah, most people wouldn't know what to do if you retire at 45.
Most people don't know what to retire at 60 also.
Okay, on that note, thank you so much, Deepak, for this exciting conversation. We talked about some macro trends. We then zoomed into, how investors should respond, and then we also talked about, where we see the markets going. So thank you so much, for sharing so much in just about 60 minutes.
Nice. So much fun there. Thank you so much, and all the best. I think you will do well to see you both. I mean, both of us have been on the stage for a while. Let's have some more fun.
Absolutely. Thank you.
Cheers.
Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.